You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And today, I'm going to keep it brief on the intro because I have like a cold or something here, and that's why I sound so baritone and masculine. Anyway, this week's Wealth Formula Podcast interview is going to be with Jay Parsons, who is Chief Economist at RealPage. He's an authority on topics affecting multifamily apartments, which, of course, is of significant interest to us as a group, particularly to our investor club. By the way, if you'd like to join an investor club or accredited investor group and see some deal flow, go to wealthformula.com and sign up for it. And then there'll be an onboarding process. You do need to be an accredited investor, by the way. But listen, this interview, again, what you're going to see is some similar themes to last week, where Harry Dent was talking about how times are kind of bad. And, he was pessimistic and generally thought we've got zombie apocalypse type situation coming up. I think that what you'll find with Jay is that he is acknowledging the current time is one of pain, which we as investors know already. So that's not a big surprise. But I think the difference is that I think Jay's a little bit more optimistic about the future. Now, what the two have in common is that they've both mentioned this idea of multifamily real estate as the darling of big money right now, which I think is very encouraging. And it makes me, as somebody who owns a lot of multifamily real estate, hoping that they're all right. I think they are, but I am also hopeful. So that's what the show is about today. And without further ado, let's get some commercials out of the way and get this interview with Jay Parsons. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Jay Parsons. Jay serves as a Senior Vice President and Chief Economist for RealPage, leading the economists and industry principal teams to provide deep insights on market trends and consumer behaviors. He's also a frequent author and speaks on topics affecting multifamily apartments and single-family rentals, including rental housing, investment and asset management strategy, rental housing, policy issues, risk mitigation, and property management. Jay, welcome to Wealth Formula Podcast.
Thank you, and thanks for having me.
Yeah, absolutely. And, this is nice to have you on right now because as we talked about a little bit offline, we, our group, this audience and me, we are heavily involved with multifamily. And obviously we had this inflationary sort of unparalleled rate of inflation, or maybe you can correct me if I'm wrong, but that sounds about right.
Yeah.
Impacting multifamily rentals. So tell us what's going on there. I mean, from the buyer and seller's perspective, and just anything right now that you think that inflation is really affecting the most.
Yeah, I know it's a great question. And, I think maybe the best term to describe it is one that we hear a lot these days, which it's been a roller coaster. I mean, you go back to March 2020, world shuts down, demand disappears for like 2 months. Nothing's happening at all. And everyone's worried about what type of investment activity is going to happen. Maybe the prices are going to go down. There's no starts that are happening at that point. And you get to like May, June, all of a sudden there's this, demand comes back and comes back and comes back. And we're like, how long is this going to last? Well, it ends up lasting like 18 months. And so we see this unprecedented boom in demand. I mean, just levels that we've never seen before. We added 1 million net new apartment renters in the U.S., market rate renters in the U.S., who, by the way, had big incomes, paying low 20% of income on rent. And then, you get to then summer of 2022 and things start to slow down. And so now here we are. Occupancy rates have been coming down. Rent growth levels have cooled off. The market's not collapsing by any means, but certainly we've seen a cooling where we're kind of starting to see a little more normal. And so I think some people kind of forget that, 10% rent growth is not normal.
Yeah, that's right.
So we're getting back to a little more normal.
Yeah. What is the latest, I guess it depends on the market, but you're in Dallas. We have a lot of assets in Dallas in our group. What kind of, rent increases are you seeing in those markets like Dallas and say Phoenix or something like that?
Yeah, in Dallas and most of the country, I'll separate Phoenix and Vegas are very different. But most of the country, I think what we're really seeing is I would say like what I would call exaggerated seasonality. And by that, I mean, these last couple of years, we really didn't see any seasonal patterns. We saw, initially a big slowdown, then we saw this big bounce. So you get into the fall, winter months, we saw some slight rent cuts in most of the country on a month-over-month basis. And in Phoenix and Vegas, we saw more extreme. It was, booming a couple of years ago and through early part of 2022.
Yeah.
Those markets have pulled back much more significantly, still a little bit more, sensitive to changes and whatnot. But overall, we're seeing year-over-year increases in the low single digits as opposed to the double digits right now.
Right. Let me ask you a question. So I think this would be helpful to clarify for the audience interest rate, how interest rates work in multifamily. Obviously, we're looking at today as this morning, the Fed ticked up another 25 basis points. But then the 10-year Treasury was actually coming down for a little bit. But then multifamily, for the most part, is based on something called SOFR. Would you do us a favor, just because I think most people would not really know very much about this. Give us sort of a sense of how those numbers correlate.
Yeah, I think, obviously whether it's SOFR, the interest rates, or, the 10-year Treasury or bond, I mean, everyone's in multifamily is looking for a comparison point for the cap rate. And what we've seen is that on paper, there should be, we should be seeing values coming down.
Yeah.
And in reality, that's really not happening. And the reason for that is because the sellers have to be motivated to sell at these discounts that are required for buyers to make these deals work, right? Because buyers can't buy with the cost of debt what it is at the cap rates that we saw from the last couple of years. We're seeing sub 4% cap rates when the cost of debt is 5 or 6. You just can't do it, right? And so where we're at this, so part of what's really happening here, I think it's kind of widely misunderstood, is that most investors are locked in at rates that are well below the current rate, so they have no motivation to sell.
Right.
So
they're
really,
cash flowing and they're happy, right.
Yeah. So I think the end result is just this slowing of just transactions. That's the real impact. And, I kind of laugh when I see people say, we see this publicly traded REITs like, hey, these values are down 20%. It's like, I guarantee you, if your values are down 20%, you would have 1,000 buyers lined up to buy that asset. Like that's not real life.
Yeah, totally. So let's drill down a little bit on that. I guess that backup there, though, that between buyers and sellers. We're obviously seeing that there's just, the market is dead, we're not, but on the other hand, it does seem like there is potentially some distress on the horizon, right?
Yes.
Do you want to address that, talk a little bit about that and why we haven't seen it sort of violently yet?
Sure. So it's a great topic. And I think this is, I think what a lot of the, kind of more distant observers of multifamily are struggling to grasp, which is that, yes, there's going to be some distress, but it's not going to be a market-wide collapse. And here's why. Number one, we mentioned earlier, most owners are cash flowing and locked in at long-term debt that is well below the current rate. So there's no issue there. Now, where the exceptions are really going to be two categories where you're going to see some pockets of distress. That's the term I'd use. There's going to be pockets of distress. Number one, you're going to see short-term value-add investors. These are the equivalent of single-family flip players. These are the 2-3 year holds. You're going to do some CapEx. You're going to sell the property. Well, you use short-term floating debt. Now, so if you look at the value-add buyers from 2021, early 2022, who bought at peak prices with the assumption they're going to do big CapEx, raise the rents 10-20%, and then be able to refinance at a still low rate, that math's not working anymore. Mm-hmm. And so I think by the time, you think if they're in, let's say 2 year, locked in for 2 years, then the rate resets, that really puts us in late 23, early 24 before we start to see some of that distress pop up. So it's going to happen where you have some owners who just can no longer see the cash flow to cover the cost of debt, and they're going to be forced to sell, or there's going to be some, rescue capital, mezz debt, or preferred equity, whatnot. And then the other category is going to be pockets of certain types of lease ups where, the lease up is not achieving its pro forma targets. You get to a refinancing event, they're not achieving the rent or the occupancy they need to get the cash flow they need. And there's going to need to be an injection of capital there. So they're doing capital calls, or again, you're seeing some distress event emerge in some of those situations. So
based on what you just said, have you guys projected, you said sort of late 23, early 24. Is that also when because of that sort of, is that when you think the housing market comes back, the multifamily housing market comes back? Because all of a sudden you have got maybe potentially a little bit of a reset, right? If you've got distressed sales and that sort of thing, or is there another answer to that?
Yeah, no, I think so. I think, and bear in mind the crystal ball is very fuzzy these days, so don't hold me to this. But I think the second half of the year we're going to see more sales. I don't think it'll be as busy as it was in 21. We saw record levels of transactions, but I think I think the freeze will thaw some by then, and we'll see a little bit of a reset between some buyers and sellers. But again, the vast majority of owners, I think, are still going to say, "Hey, look, I'm good." So I do think we'll see more opportunity the second half of the year.
One of the things that comes up when we talk about distress is, in this scenario, right? I mean, we had an incredible increase in rates, and so the number of operators that will be in distress is not small. It's significant, right? Obviously, lenders don't want to take these properties back. Do you foresee some kind of, rescue in terms of, the actual lenders, because, they don't want to become landlords, right?
Yeah, no, I think very few are actually going to go that far. And the reason for that is, number one, there's a lot of buzz in the industry right now among traditional equity investors. They're now looking for preferred equity deals. And so they're looking to basically slide into the top of the capital stack, be the rescue, and then position themselves to eventually potentially take over the asset. And there's we'll see if the proof's in the pudding, but, the buzz around the industry is there's quite a bit of, dry powder looking for that strategy, because they see it as a higher yield, lower risk investment than an acquisition at a lower cap rate. So a traditional acquisition. And the other side of it too is I think you're going to see a lot of owners who are reaching distress who would rather sell and try to break even as close as possible than just lose everything altogether. So I don't think we're going to see a lot that goes truly into foreclosure. And what does is going to be, very unique, sort of messy stuff.
Do you guys even try at this point to, really to predict what rates are going to be?
No. I tell people all the time, forecasting interest rates is like a fool's errand, just like forecasting the price of oil. Like it's just... Yeah, you're just guaranteed. All you're doing is saying, "Hey, hold me accountable for something I'm going to be wrong for."
That's right.
So I try to avoid that as much as I can.
You could just look at curves all you want, but I'm not going to talk about it, right?
I think obviously the mainstream expectation is that rates will be coming down by the time we get into next year, and I think that's a reasonable expectation. But I'm not going to stake my career on it. So
exactly. How, one of the things that you mentioned was that generally, as a general rule, that maybe some of these rate increases, rent increases have leveled off. And what I find a little bit difficult to understand with that is, unemployment's really not a problem.
Yeah.
And wages don't seem to be a problem. Mm-hmm. So why are rents leveling off?
Yeah, I think this is your question is great. This is my favorite topics because a lot of people still assume that there's some sort of jobs to demand ratio in the apartment market. All brokers put this in their packets. It's a bogus metric, but we've never before seen a period like this, which is you have great job growth. You got great wage growth. They didn't quite keep up with inflation, but it's still the biggest numbers we've seen in 30 plus years. And unemployment's really low. Unemployment's the lowest level in 50 plus years. And yet there's very little demand, not just for apartments, but for any type of housing. People aren't buying houses, not renting single-family homes and any kind of big net new numbers, and obviously not seeing a lot of apartment demand. So, I think what's really happening over the last 9-12 months has been this, low consumer confidence that then manifests in the form of reduced household formation. People just aren't moving around as much as they were previously. Now, having said all that, I think all that job growth and wage growth, it creates pent up demand for housing. Yeah. And so I'm of the view that as we'll see here in these, we're about to enter the peak leasing season. April through August is the busy season. And so I'm of the view, though, that we're going to see some pretty good demand, not 21 levels come in, but I think we'll see some solid net new demand for apartments this year from people who said, you know what, last year was too crazy, I'm going to wait it out. And now they're saying, okay, there's better deals out there. Rents aren't up as much. There's more vacancy, more supply, more options. I think people are going to move around more, and we'll see some better demand.
In places like DFW, there is overall, correct me if I'm wrong, but a shortage of multifamily dwellings. So that has got to also play into this, right? I mean, in terms of the pressure going back up.
Yeah, well, I mean, yes and no. I mean, there is a shortage, absolutely. But the problem all across the country and in DFW is that the shortage is predominantly impacting the more affordable end of the market. And you can't really build affordable housing without subsidies, and you can't build a Class C, you can't build a Class B apartment. Yep. So most of what gets built is Class A expensive apartments, and those will get leased up. But you're competing with a fairly finite pool of demand at those price points, and so. There's a little bit of a mismatch there. But at the end of the day, we just need more housing of all types, and that'll help. Now, to answer the question on the rents, though, is that, what we're seeing is that with all the supply in the market and the slowdown in the demand, that vacancy has gone up. And so, supply and demand, there's more vacancy. It puts, it removes some of the upward pressure on prices. So these things are cyclical, right? I mean, we're going to see it move up and down. But, right now we're at a point where, where increase in vacancy is reducing the rent growth.
Isn't the vacancy, is that, how does that work when you look at A class versus B class versus C class? Because, the way I think about it, I think of people kind of moving down the ladder. So if vacancy is up in A class, does that mean that it's potentially slightly down in B class? Or how does that work? I mean, just because I think people, including me, sometimes wonder, well, where are these people going if there's all sorts of vacancy, right? They got to live somewhere.
Well, yeah, I mean, first of all, when I say vacancy go up, it's going up from the lowest levels in history.
Sure.
And so it's not up that much in the grand scheme of things. Now, and it's changing the same right now in Class A, B, and C. And so it's not that they're really going anywhere, because we're not seeing a lot of move outs. It's just that people aren't really moving in from, there's not seeing any net new creation over these last 6 months. Now, what we do think, I'll tell you, my view is that as more supply is entering the market at the Class A level, and that's really going to be hitting these, next 10, 12 months, maybe actually probably beyond the end of the first half of 2024, I think we'll see much more vacancy in Class A than we do in Class B and C. I think the price point, you mentioned, maybe the flight to affordability, but the challenge also is that the price point and the difference between A and B and C has gotten so big that they're really dealing with different demographics. Yep. So you're not going to see a big spike in availability for Class B and C apartments.
Yeah, that's right. That's right. I mean, basically, you're just saying like the A people are not going to move down to C class, right? Right, exactly. No, that makes sense.
Well, no, in fact, what's going to happen is the Class A people are moving around, but they're going to another Class A property that's offering a big concession because of lease out competition. Yeah. Like that's where the discounts are going to be. Like the best deals are going to go to the higher income renters in Class A properties on a relative basis.
I'm curious how this, and I don't know. I mean, I think it's all baked into the economy, but the current banking crises that are happening, is that affecting the real estate market at all?
Yeah, it's interesting. There's a lot of conversation about this, but as I talk to folks in the industry, it really doesn't have a direct impact. Now, but before I say anything more, obviously what everybody's really worried about is that there's some sort of snowball effect to the broader economy. So obviously we want to be careful that does not happen, but on a direct impact basis, it's pretty muted. Signature Bank was a major multifamily lender in the New York area. So there is, some of that impact, although, all of that's being picked up by others in terms of servicing. But, in general, as for the multifamily side, the GSEs, Fannie and Freddie, are the big players, and they're not impacted by this. So, and there's a big article in the Wall Street Journal about commercial real estate exposure among banks, but a lot of that is really more on the office side, where you're dealing with high vacancy and some cases where the owners can't pay the debt service anymore. So, multifamily is not really directly impacted at this point.
Right. You mentioned Fannie Freddie, and that leads to another question, which is one of the things that we're seeing is that Fannie it's a much tougher deal to work with Fannie and Freddie now, less leverage, more requirements. Do you see that loosening up anytime soon?
I think it will a little bit, and I've heard anecdotally it will a bit. I mean, remember, they have caps they are supposed to, they're supposed to hit. They can't exceed. So they do want to achieve certain volumes, and part of their mandate is really to keep the market pretty liquid, and especially in the more affordable end of the market, where they have some mandates to really service. So I think that there's going to be, obviously they're still impacted by, higher interest rates and whatnot, but I think they're going to do what they can within reason to remain active players.
But I hate to, obviously economists don't like to predict the future, but they do. Right? That's right. Yeah. And so tell me how you think this is going. Give me a 1 year, a 3 year, and maybe a 5 year perspective on multifamily in terms of how you guys are looking. And obviously you're advising a lot of large groups and that kind of thing. I just I'm kind of curious what your take is. Even more, you've talked about the 1 year basically. You're looking at some dips and maybe it coming back, but 3 years from now and beyond. Tell us what you guys are projecting.
Yeah, like you said, the next year is going to be choppy. It's a tough time to enter the market for a short-term value-add player that's been a big part of the market the last really 10 plus years. But long-term, it's, I think people have to take a step back and realize that, the structural tailwinds behind multifamily really haven't changed. The demographic story is favorable. The cost to rent versus own, despite all the rent growth, is actually more favorable than ever. The need to have a home, like you could work from anywhere, you could shop from anywhere, order food from anywhere, but you got to have a home, and that's a big structural driver. The shortage of housing, there's numerous everyone's worried about millennials are aging up into family homes. Well, they forget that Gen Z is just as big, if not bigger. They're coming right behind them. Right. So there's a lot of very positive drivers that will remain factors. And by the way, that's why you talk to the largest investors. They still love multifamily for that reason. These things aren't going away. There's noise, sure, in the short term, but these long-term factors aren't going away. So we're still pretty bullish on the next 2 to 5 years. I don't think we're going to see anything like what we saw. If you're a new investor since COVID, you need to sort of erase your mind of what you think is normal, because it's not. Right. But I think what we'll see these next 3 to 5 years is more like what we saw in the 2010s decade. Which is 3 to 5% rent growth, 95% occupancy.
Yeah. Would you mind for us, sort of compare and contrast? Because we've talked about multifamily, but there are some single family investors and that kind of thing. Yeah. What's going on in that part of the real estate market right now? Is it pretty parallel? It seems like it's a little bit of a different animal.
It is a different animal, but I'll tell you, it's like one of the things that always fascinates me is you have multifamily homers, you got SFR homers, and you got the for sale home building homers. And what I always try to remind them is look, all of y'all are riding the same basic winds, or you're riding the same waves here. They go up and down together. We see demand for all types of housing ebbs and flows together. You look at the big home buying boom of 2021, or even the mid 2000s, there was a lot of rental demand at the same time. And then when the home buying stopped, we didn't see a lot of rental demand. So SFR is really a similar situation right now, where there's not been a lot of demand. At the same time, you have more supply. There's a lot of, build to rent communities, which are obviously apartment SFR hybrids. And then there's about 100,000 of that coming online. Plus you got, we're seeing more homes from owners who don't want to sell, who are choosing to rent out their homes for a period of time. So there's more inventory on the market. That's putting some pressure, downward pressure on rents also. So they're very different in terms of who they cater to and demographics, but the overall performance has been very, very similar.
Just going back to your comment on investors having this as still a darling asset in multifamily and that sort of thing. There's got to be a tremendous amount of pent up demand. I know, certainly even in our group, people want to deploy capital, right? And there's nowhere to play it. And you hear about larger groups having mandates and that sort of thing. Where's that money going? Is that where you're talking about with some people looking at preferred equity and that kind of thing mostly, or how is that working right now? Because one theory was that pent up demand would sort of save the day, but I'm not sure that it really has yet.
Well, I think what's happening is, there's a lot of, in fact, you would know the big NMHC meeting was in January or February. I guess it was early February this year in Vegas. And I was really struck by the fact that it's like everybody's a buyer. There's so much dry powder out there. You see the data on this anecdotally say, but also too, it's like nobody wants to be a dumb buyer. And
right.
So there's all this capital, but they're waiting for the right moment. Maybe they wait too long. We'll see. But I think what's happening is a lot of these, asset managers, investment managers, they're telling their investors, hey, sit tight with us a little bit. These opportunities are coming. Yep. The money's they're saying at least the capital's there. And at the right moment, we're going to see it. So I ultimately think that, the downside, we mentioned some of this distress coming. I think there's a really there's a hedge of protection here with all this dry powder that really wants to be investing, but just can't justify, a 4.5% cap rate right now.
Right. Fantastic. Well, Jay, thanks so much for joining us. What are you making of your Cowboys this year?
Yeah. Well, every Cowboys fan knows that every year starts with tremendous optimism and ends in terrible defeat. So I'm kind of conditioned to forecast the same for this year.
Yeah. Well, I'm a Vikings fan, so I don't want to hear any complaints from you because you win it. Anyway, Jay, thanks so much for joining us on Wealth Formula Podcast. Love to have you back in the near future.
Would love that. Thank you.
Be right back. Welcome back to the show, everyone. Hope you enjoyed it. I had some chicken soup, and I'm feeling a little bit better now. Anyway, I think the big theme here with Jay is that, right now we're in a period of some pain, and I think there is a little bit of pruning that will happen. I think it's going to be harder and harder for, everybody to jump into the multifamily game like they have over the last, since 2008, 15 years. So where people have really made money no matter what, and then it made everybody else go into the game. That's not to hope anything negative for these people, but I think there's a pruning effect that happens in these situations, and I think you're going to see that. I do think that there is generally pain, even with, the best of operators, as we've seen some equity calls and things like that. But the good news is, as Jay has suggested, that there is an incredibly strong demand for this type of asset as well, which along with, the idea that, there will be a day when the Fed is not raising rates, when inflation is down and SOFR is reflective of that current situation where rates will come down and at the very least stabilize. I don't see them coming down a lot, but I do see them stabilizing and creating goalposts that people can use when it comes to underwriting and sellers can use as a basis for what they're asking for properties. And that's what we don't have right now. But that's it for me this week on Wealth Formula Podcast. I hope you enjoyed this show, and we'll see you next time.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.